The NASDAQ 100 is 90% above its long-term trend. Is there an AI bubble?
Unfortunately, bubbles can only be identified after the fact. But fortunately for investors, there are other areas of global equity markets that look very attractively priced and have some pretty strong forward-looking returns.
3 concerns heading into year-end: the potential for an AI bubble, the continuing government shutdown, and worries about the US labor market.
We're going to break down our research on these topics and discuss how we're approaching these risks heading into year-end.
We're here today to talk about the 3 things that are really worrying investors these days. Let's start with the government shutdown. We are now in the longest government shutdown in US history.
In our prior video, we talked about how we would be surprised if the government shutdown lasted this long. So here we are, surprised. But we also said historically the market looks through government shutdowns because it's usually a temporary loss of economic activity that's recovered in the next period and has very little, if any, impact on long-term earnings growth of companies. And that was correct. Thus far, the market has totally looked through the government shutdown. The S&P is up 1.7% during this shutdown.
And hit a new record high.
Exactly. So let's try again here and try to predict when the shutdown could end. At this point, the catalyst to end for both sides to come together for a compromise is just the fact that government employees have not been paid in a really long time. And does that start to create even more disruptions at airports and other places like that? Also, SNAP benefits, those benefits have run dry. So, folks aren't getting that type of assistance. Elections, we had some elections last night. Those are over. The Senate's going to go on recess. Is there a catalyst for compromise? Betting odds suggest there's over an 80% chance that this does not last into December. So we'll see how that goes. And if they do come together and compromise, then there's a question of the economic data that we've been missing. We have a couple of non-farm payrolls reports, a couple of jobs reports, a couple of inflation reports, which are key pieces of information for the market and, of course, for the Federal Reserve.
Yeah, that'll be, markets are looking for that data, right? And thankfully, the Department of Labor is releasing the state level data, not seasonally adjusted, so we can do a handful of calculations to kind of check in on jobless claims. Not too concerned at the current moment, right? Well below our labor market recession signal, but some announcements coming through that give some pause.
Yeah, we've seen more and more announcements from large employers about job cuts coming. So we're anxiously awaiting the aggregation of that data. Challenger Grain Christmas is one of the leading providers there. So we'll be looking at that. But thus far, it's great that we've been able to get the jobless claims data. We've had to sort of gather it ourselves and do our own seasonal adjustments, but it looks like we are nowhere near recessionary levels of firing. If you look at alternative data for the jobs market, ADP, for example, other private providers, it does not look like the labor market has fallen off a cliff or rallied significantly. It looks like we're still in a position where very few jobs are being added, and the concerns about the health of the labor market that the Fed brought up, it doesn't look like those are going to be alleviated if they get those non-farm payrolls reports once the government reopens.
Yeah. And so that Fed note is important, right? Important to state that our recession signal remains inactive, particularly the labor market signal. But given those comments from the Fed and what we're seeing here, any changes to our expectations for one more cut in December and then 2 more in 2026?
That's still our base case. Jerome Powell's press conference at the most recent meeting was a bit sloppy, trying to sort of voice the opinion of a divided committee. But he also stated that inflation, especially if you subtract out tariffs, which are a one-time price increase, is very close to the Fed's target, and there still are concerns about the labor market. So, it was the Fed's base case for another cut in December, and we don't think the data is going to change that. And so December to us still seems like a rate cut. Yeah,
makes sense. So that's the labor market and the government shutdown. Let's get to what really gets the people going lately, and that's the AI spend, the potential for an AI bubble. How are we thinking about that, both in terms of the companies included and how this could play out?
you'll generally hear two types of bubbles being brought up. One is a bubble in AI-related investment, infrastructure, CapEx, et cetera. Is there too much spend there? And then the other is a bubble in AI-related stocks, share prices. So we're going to try to bridge the gap, bring these two things together, and share with viewers how we think about what's going on here. So starting with the 7 US hyperscalers, they're doing all the spend. They represent about 17.6 trillion in market cap. That's about a quarter of the total value of the US equity market. So they are a big deal. And if you look at consensus estimates, these 7 companies are expected to spend a little over $7 trillion on capital expenditures to build out AI infrastructure, things like that. That is a huge amount of money. That's where you get the bubble worries. $7.2 trillion, for context, is about a quarter of nominal GDP, thereabouts, a little less than that. The other concern here is that this is sort of a new business model for these companies. Over the prior 10 years, the 7 hyperscalers combined only did about 1.2 trillion in CapEx. These were capital light businesses. Right. That's what was so beautiful about them. This is totally different going forward. They're turning into capital intensive type businesses. So the question is, are they going to be able to generate enough of a return on this huge investment spend in order to keep investors happy? And so the way we try to figure that out is we say, based on this spend, what type of revenue growth do these companies need to generate over the next 10 years in order to maintain their historical average return on invested capital? And that should be satisfactory. And it's actually not that extreme of a number. We estimate it's about 6.7% annualized revenue growth just to maintain their historical return on invested capital after all this spend. And as a point of comparison, the consensus estimate over the next 10 years is 9.6%. Over the prior 10 years, these companies have generated revenue growth of 18%. So is the spending too large? Is there a bubble in AI CapEx? We don't think these numbers are actually outrageous yet.
Right.
If we ran the same analysis but suggested these companies needed to generate 20, 30% revenue growth, that would be a serious problem. That would be a bubble that we would be worried about. But as of now, that is not the case.
Yeah. So reasonable revenue thresholds, right? But this is still an entirely new business model for these companies, right? So even though the expectations can be reasonable, there's some significant execution risk. And we're facing some notable concentration within the US stock market. And in those periods of concentration, or I should say following those periods, we tend to see outperformance from small caps.
That's right. Usually when the market is as concentrated or top heavy as it is now, specifically right now, 35% of the US equity market is in just 10 stocks. It's a lot of those hyperscalers plus names like NVIDIA, for example. When that has happened in the past, small caps tend to outperform large caps over the next 3, 5, 10 years by over 3.5% annualized, a decent margin. And there are a couple reasons for that. One, you spoke to, maybe the expectations for these companies are too high. Maybe they just fail to live up to them. Maybe there are execution risks associated with all this AI spend. And so just other things do better maybe in a down market. The other one is, if all of this spend happens and AI is what everybody hopes it could be, then the benefits of AI could perhaps benefit smaller companies as much, if not more, than some of these larger companies. If smaller, old economy type businesses can harness the power of AI to increase margins and reduce costs, then maybe they could outperform. But you can see, as you said, there is a lot of concentration risk in the market. If you're owning a passive index fund, you own the AI theme. Another way to look at it, if you look at the top 3 AI ETFs by market cap, about 40% of the US equity market cap is in one or more of those 3 AI ETFs.
So diving in a little bit further on the is this a bubble question, right? Checking in on one of our favorite valuation metrics, distance from long-term trend. I mean, checking in on the NASDAQ 100, 90% above long-term trend seems like a big number in absolute terms, but how does that compare to history, and how's the rest of the market looking?
Yeah, 90% above its long-term trend, meaning it's performed extremely well and is very expensive on that metric. If you think it's a bubble or you don't think it's a bubble, there's something in this chart for you. So if you're saying it's not a bubble, well, just compare it to the early 2000s with the tech bubble, the NASDAQ 100, those types of stocks were over 200% above trend. We're clearly nowhere near that. There was a lot of lunacy back then that we just aren't seeing right now. Right. So that's the good news. But if you're an investor, you're thinking about price risk, you're thinking about valuations, you're thinking about diversification, you'd probably look at this and say, wow, this is as expensive as it was at the end of 2021. And we know what happened in 2022. NASDAQ 100 got a lot cheaper. It was down about 50% at one point during that year. So this could be the level where investors start to get concerned about prices of these companies. The good news here is if you go outside of the NASDAQ 100 to other areas of the equity market, they're not that expensive at all. Large value stocks are only 13% above trend. Small value stocks are below trend. Foreign stocks are below trend. Yeah. So there are areas of the market to diversify into that don't have a lot of this price risk embedded into them. And if you assume mean reversion, so NASDAQ comes down to its trend, these other areas of the market come up to their trend, you can look at the forward-looking expected returns. For small value stocks, if you mean revert over the next 10 years, you'd earn 13.4% annualized.
Well, we're entering a pretty attractive time of the year historically, right? Past performance is no guarantee of future results, but November and December generally been some of the best performing months for the S&P 500.
This is the data behind the idea of a Santa Claus rally. Typically, November and December are two of the strongest months, seasonally speaking. And then if in the first 10 months of the year, the S&P is up over 10%, which is the case this year, you see even stronger returns in November and December. If we were to try to summarize this, you look at the government shutdown, we're still very hopeful that this wraps up soon, and we think the market will continue to look through it for the reasons we provided.
Yep.
In terms of the labor market, there is enough concern to keep the Fed on track to cut rates, but thankfully, we're not seeing an abundance of firing that would lead us to believe a recession is in the cards, or that should be positioned for. And then when it comes to AI, we don't necessarily think the CapEx spend is unreasonable or too egregious at this point. A lot of these companies, though, are expensive, and they represent a huge chunk of the market cap. So diversifying into other areas of the market, thankfully, that are much cheaper, makes a lot of sense. And then seasonality is your friend into year end. So staying invested in a diversified portfolio still makes a lot of sense.
That'll do it for this edition of The Outlook by Sageview. If you have any questions or comments, please feel free to reach out.